We're family.
realized very late in the day. You are.
I'm the founder, one of the founders.
Yeah.
Yeah.
And I must admit, right up until the point we were acquired, I had no idea most was a commercial entity at all.
Yeah.
So I used to work at CPI and we would take
Yeah.
the early days stuff.
Yeah. Oh, I was involved in setting it up. Actually, first a foundation, then a company.
Yeah.
Then it was bought by some U.S. Green Building Council, the subsidiary, and then I was out.
Yeah.
I'm still involved in the mails and whatever, but I was out in the. And I'm not a real estate expert. I'm more a sustainable finance expert. But I started it off in a spreadsheet with 30 lines, and that's it, and a report that we made based on very basic data in 2009. And then they loved the first report, first year, 2009 or so, and then we scaled it up. It's really fantastic to go through it, but I also know that I don't want to do this again. It's so stressful, setting up companies and...
the early 3 or 4 years.
And without Niels, we couldn't have done it. Niels Kok, he was the traveling Wilbury to all of the places to get clients and to understand that people understand. That was, and you are now working with?
With Asset Impact, which we're now a subsidiary of.
Okay.
We started as a spin out from investigation.
Oh yeah. And who's then involved in that? Is it Jacob Tonner?
Well, he's out.
He's out, yeah. He went to this other thing, eh? But Asset Impact is still related to the green investing?
So Asset Impact was the provider of data that Pacto is based on. So it's the asset data.
Okay.
Which is a very appealing idea for companies. Full circle, Mills and you know Ava Stevina?
No.
She was at Maastricht recently and then she went to York University in Canada.
Okay.
We decided to give our data to academics for free, so we're working.
Yeah, I think I know who she is.
Anyway.
See you later. I'm here for 2 days. Yeah, so listen, we're going to do this different.
Okay.
I'm going to be the so I leave this for Al so that he can join me. I can give him a tap on the shoulder and thank you, you know? You just use the thing. You don't have a minute, that's good stuff for you. So after they did their introductions, I'm going to stand up and walk myself.
Okay.
And then the other mic can be used. So I'm going to just ask Jamie whether he does it or whether you can do it.
Okay. Yeah,
Jamie,
happy to do it if you-
one sec, sorry.
Okay.
And we have to start, by the way, in a few minutes.
Yeah.
Are you going to walk with the mic or shall we let...
Yeah, I'm happy to.
Okay, then let's do that. You can just follow the timeline.
Okay. So you can just maintain eye contact.
When I start walking around, you have to take, so just say it. Sometimes I might do.
Hello, Sophie. How are you?
So I was just thinking.
In the home.
I was going to say,
I know.
but before we start, let's have a thank you.
I have to say the recording thing is, yeah, it's annoying.
But you can always say
The main reason it's annoying is there's a huge light shining in.
like it's irritating.
It's horrific.
Yeah, it's horrific.
We can't help. And then
It's
do
probably
anything.
for the recording, I guess.
Just takes it. Yeah. I'm like so interested in reconnecting.
I know, well, I think
So it's like, yes, that's really, really nice. I get to do. And there's a very specific topic that I would love, which is the pension schemes bill. Which
Can I just start?
I'm going to get start. I'm not just.
You're going to start. You can. You,
Perfect.
yeah. Okay, dear panel members, can you please sit down? So the last session is going to start. It's going to take 90 minutes, and then we're going to divinity halls. My name is Bauer. I'm a professor of finance in Maastricht University, and actually I'm quite often here in Oxford as well, as I cooperate with the Oxford Sustainable Finance Group. And I'm going to lead this panel, chair this panel, on stewardship. We're going to do it a bit differently. So we're going to have a few introductions of a few minutes per person, max. And then we're going to open it up to you already. And don't be afraid, I'm also going to walk around and maybe even give you a mic when you don't expect it. So we just want to make this a bit more lively. It's the end of the day, there's a lot to say. That's the plan at least. So I hope you cooperate with us and ask questions to the panel, as many as you want. Okay. So what is stewardship actually? So I checked it, of course, in the Oxford dictionary, and it said the responsible management and oversight of something you don't fully own, but have a duty to protect, improve, or sustain, often for others or for the future. That's a great summary, I think. But when you look at what happened in the past, is that a lot of those stewardship activities in these tumultuous geopolitical times actually did not work that well. Coalitions collapsed. Stewardship wasn't really effective in many cases. It was heavily discussed and debated. There were even court cases on it, if I remember correctly. And what you hear a lot as well is that there's no provable additionality or real-world impact. So a lot of things to discuss. We can discuss this. We will look a bit back in time, we will look forward in time, what can we do in the future to make it more efficient. And then, as Ben said this morning, the theme of this Oxford Sustainable Finance Summit is to reinvent and to renew. So help us reinvent and renew stewardship. And maybe this session will be the base for a new stewardship code in the UK, who knows? Anyway, but before we do that, I first want to have 10 seconds of silence, because the person that was supposed to sit here was an asset manager. We tried to get one, and the asset manager did not actually want to join our panel. We tried 3, 4, 5, 6 times to get a US manager, didn't want to join the panel because it's recorded. And then we tried some others, they also didn't want to be in the panel. So for that reason, I asked a very special person to join the panel, which is Alex Money. Give him a big applause. Because it's the first person in this panel I'm going to introduce. Alex is actually also connected to the Oxford Sustainable Finance Group, but has a background in asset management. Actually is also in a corporation right now, so he can talk from different dimensions on the topic of stewardship. Next to him is Catherine Howard. Catherine is the CEO of, or the executive director, what exactly do you call yourself? Yes, of Share Action. And then she also is in the board of Nest. So she has a really interesting double role of being member of I think you can call it an NGO, or at least something similar. And at the same time also a trustee of a pension fund, an asset owner, in which stewardship is also very important. And next to Catherine, we have Alan, the weapon from Canada, I always call her. Also working at a university, actually in Cambridge, where she advises the university also on responsible investment. And then next to Catherine, there's David. And David actually has a legal background, works at Freshfield, Brockhouse and Deringer, if I hopefully pronounce it correctly. And he will give this legal perspective, because there are many legal questions that you can ask in the context of stewardship and the way forward. We're going to have short introductions, as I told you. Alan will start, followed by Catherine, David and Alex. And after that, I will take my mic and walk to you and see what questions you have, or maybe I ask you questions. Before we start, Alan, I just want to ask one question, if you're okay. Are there any asset managers in the room? Please show your hands.
I can go.
You can also go up, yes, yeah? Only 4? Okay, we have to do something about that in the future. You're one as well? Okay, be prepared. Okay, Alan, go ahead.
Okay, great to be here with you all. What a great panel. I'm going to just start by being a little bit provocative, because that's more fun, and I know that's what Rob would prefer, keep things interesting. The first thing that I'm going to say is that I'm not sure that I believe in stewardship anymore. I've been reviewing a lot of the evidence on the actual impacts of shareholder engagement, and it is hard even to find examples, case studies, in which there has been anything close to meaningful change as an outcome. That's a little disturbing. I mean, you can get plenty of crappy disclosure. Usually that's the ask, right? Usually the stated goal of an engagement is to get information out of a company, and we know that the information we tend to get is inadequate at best. And there's a meta-analysis from 2020 I keep referring to that finds a weakly negative relationship between improved environmental disclosure and actual environmental performance. So the disclosure is unlikely to get us anything either. And this is because of win-winism. I mean, the things that we need to do something about are large-scale, systemic, and based on really profitable externalities. Why would a company halt the activities that they're taking part in that are the basis of their profits? So I think there's kind of a fundamental reason that we're not seeing success from stewardship. I will say this, the thing that they will pay attention to is losing business, losing shareholders, especially when public. So if you combine much more harshly worded shareholder activism with actual consequences, loss of mandates, divestment, et cetera, that's where I can be convinced. And then just a quick note on conflicts of interest, because I'm completely unsurprised that your efforts were unsuccessful, Rob, in getting a manager on the panel. I've actually been looking at the academic evidence on conflicts of interest lately, and I cannot find a single paper that does not find conflicts of interest in the asset management industry. So since this room probably has a lot more asset owners than managers, I'll say this. You cannot rely on your asset managers to do what you would want on climate or any other systemic issue. And there's a whole raft of papers showing why that is.
Thank you very much, Alan. Very succinct. Perfect. Catherine.
Okay, shall I get going? The questions from Rob come later, just remembering this is the intro bit. So, well, likewise, it's great to be here on this panel and back at this excellent event. I'm going to be a little bit less gloomy, but only a little bit less gloomy than Ellen, although she really does take the prize for that, just with that intro. But I will concede that we are in what I've been calling a stewardship recession, as in we are out of and I think it's a good thing that we're out of the sunny uplands where everybody claimed to be doing this work with great earnestness and seriousness, and it wasn't delivering huge results. But when the tide goes out, you do get to see who's for real, and I think one of the benefits of this moment in time is that we are much more able to see which institutional investors are serious about stewardship and which are not. And that does actually, and we'll perhaps come on to this later in the panel, pose some really interesting challenges for asset owner fiduciaries who have policies that say that stewardship is a really important part of risk management for them. So where should they allocate their mandates? But one of the things I wanted to just observe is that I think part of what is interesting at this moment in time in the stewardship space is that it's revealing that this work was always quite political in the sense that it involves some challenge, done well, of very powerful corporate entities pursuing their narrow economic interests, and the process of stewardship involves challenging that when you've got shareholders, well-diversified shareholders, that think that the imposition of, the externalization of costs onto society, the environment, and the wider economy is actually not in their interest. And it's certainly not in the interests of other actors in society who maybe, as pension fund members, put assets or money every month into a pension scheme. So there are some underlying conflicts. These are genuine conflicts rather than conflicts of interest. And the process of stewardship is about sort of unearthing those and pushing big corporate entities to behave in a way that's really in the interest of the underlying investors. And that has been, become a much more political enterprise, and particularly the Republican right in the US don't like it at all. And so what they're doing is just sort of exposing what was always true, that this is a sort of bit of a political project. So I just throw that out for discussion and debate. I think it's just made overt what was always true, which is that good stewardship, and there's very little of it out there, was always a process of challenging power, and that's become more scary when those sort of incumbent interests backed by politicians say, well, we really don't like this, so could you all back off? And so a lot of large institutional investors have backed off. And so one of the things that's falling apart right now are the sort of big, flashy initiatives. I won't name them, but maybe we will get to name some of them over the course of the panel discussion, where hordes of institutional investors had signed up and said, oh yeah, we're in on that, we're going to do this stuff. But actually, they weren't committed to really escalating and driving until they got results from companies to manage externalities in a more appropriate and real way. And so what's been a feature of a lot of the stewardship space is a lack of discipline around the process. And I'm just going to spend 1 minute just to describe what I think a disciplined process of engagement and stewardship looks like. It involves the building of power, so a base of investors holding company shares that collaborate, work together, and are prepared to act together. It involves the setting, ideally publicly, of expectations of the relevant corporate entities based on real analysis of what they need to be doing to manage systemic risks and other maybe idiosyncratic risks more in the interests of the participating shareholders. Escalating predictably, often by communicating in advance what your escalation might look like, and then genuinely listening and engaging so that there's a real exchange between the company and this group of shareholders to drive results, and a negotiation often. So there's much too little of that. That's what really good stewardship looks like. And there were a lot of actors in the space saying that they did that when they didn't do it. And what's happening right now is a sort of flushing out of all of that, and I think that's really good. So I think I might have used my 5 minutes. I've got more specific things to say, but they'll come up in the next hour and a half.
Perfect. Thank you very much. Next is David.
Okay, a slight change of focus here. We've been looking at what success means. Success has a legal dimension as well. And it's important from a legal perspective to think about this question of successes and failures in the context of stewardship. What exactly is a success or a failure from a legal perspective? Because if that will have a bearing on whether people can engage in it. We're talking about legal vehicles. They're run by people who have legal duties. The vehicles, what is possible for each of those vehicles is defined by law. So this question of what is effective and how the law understands effective is really important when we come to this question. And we can look at that from two perspectives. We can look at it from the point of view of investor duties, and we can look at it from the point of view of investees. From the point of view of investor duties, you've broadly got asset managers, we've heard about them already, and asset owners. For investment managers, stewardship, effective stewardship is essentially stewardship that is consistent with the goals that they have been appointed to pursue under their investment mandate. That is it. So a fairly simple answer at one level. Second, for asset owners, stewardship, effective stewardship, is stewardship that is consistent with achieving the investment goals that they have been given by law. And for most investors, that will essentially be financial goals. To the extent those investor goals depend on the idiosyncratic performance of investee companies, then clearly stewardship that can enhance or support that idiosyncratic performance is going to be aligned with those investor duties. But as we know, for many investors, the most material financial performance risk they face is systemic, resulting from threats from climate change and other sustainability factors. So that their investor duties should be causing them to consider stewardship aligned with tackling those sorts of threats, those systemic threats. I'm not using the expressions systemic stewardship or system stewardship because they're not legal concepts and they potentially come with their own baggage and they can result in legal confusion, I think. Now, that's investors. What about investees, investee director duties? What's effective stewardship from their perspective? Well, it's stewardship that enables them, that supports them in achieving the success of their company for the benefit of shareholders. Who are the shareholders? Well, the asset owners that I've just been talking about. And again, there's an idiosyncratic dimension to that and a systemic dimension to it. And both idiosyncratic risks and systemic risks fall within the scope of directors' duties. Now, there are variations between jurisdictions when you look at that, but very clearly, from the point of view of UK English law, they are squarely within the scope of directors' duties. Now, these duties are highly nuanced and subtle in the way that they apply, and I think very often market discussion of these duties doesn't always adequately reflect that. And a common misapprehension that I come across is that unless a specific action has got a measurable benefit to the person taking it or can demonstrably achieve some impact, then they shouldn't be doing it. Or conversely, if it creates a measurable loss for that investor or company, then they shouldn't be doing it because it breaches their fiduciary duties. And to be frank, some of the research one reads on stewardship seems to reflect those sorts of understandings. But if we look at the systemic dimension of these duties particularly, addressing systemic risks is a society-wide, complex, non-linear, polycentric process, so that outcomes are really not very easy to measure in that way. There are different levels to that. So, for example, you could have a situation where you have a particular stewardship goal that you manage to achieve. Let's say it's getting a director removed from a board, but it doesn't have any measurable effect, as far as anyone can tell, on the systemic threat. You can turn that on its head. You might have a situation where a particular shareholder initiative fails, but that doesn't necessarily mean that it's not had some positive outcome in terms of reducing systemic threats, in terms of tackling the root of a risk. So these issues become a great deal more nuanced once you start to apply an accurate legal lens. Now, when outcomes can be predicted and measured, clearly that needs to be factored into legal decision making. But equally, robustly grounded narratives, and I emphasize robustly grounded, not some flight of imagination, robustly grounded narratives can also provide a legally sound reason to act. For example, in the form of scenario analysis, theories of change, and things like that. So in summary, approaching how to discharge investor duties, when you're approaching it, the effectiveness of stewardship may sometimes be something that is predictable and measurable, and that's highly relevant if it is, but equally the basis for effective stewardship may rely on robustly grounded processes based on more qualitative and narrative understandings. And both approaches are potentially consistent with discharging fiduciary duties in the context of stewardship.
Thank you, David. Finally, Alex.
Okay. Hello. So I'm just going to confine my remarks to the perspectives from sort of two groups, from the investment manager and from the issuer company. I do recognize the irony in that I'm in neither of those groups. But in my defense, I have been in both of them. So I just want us to just think about this in terms of, you know, the old chestnuts in finance, risk and return. And just think about risk and return from the perspective of the motivations for an investment manager and the motivations of an issuer. And for an issuer, let's just think about this as the sort of C-suite or some equivalent. For an investment manager, for an active investment manager, let's just focus on them, because that's where the kind of rubber hits the road, I think, with stewardship. They are mostly financially incentivized to think about return. They are, to an extent, financially incentivized to think about risk. It is true. But there is still some asymmetry towards thinking about return. If you're an active investment manager, conscious risk-biased investors will use other instruments, including passive investments. This is my view as an ex-fund manager. Contrast that to the position of an issuer, and again, let's think about the C-suite, and let's maybe even think about the CFO, which is often the point of engagement in stewardship. They are heavily incentivized to think about return. And they are very rarely particularly incentivized to think about risk. This is the reality. Not narrow financial risk and all of that, but generally secular in terms of thinking about this. And I think this is, and there are lots of reasons, behavioral reasons, and all sorts of stuff that we can go into about that. But I think this is where the challenge has been and the opportunity exists. Because I think that the narratives around stewardship have generally emphasized the risk side of the equation. And engaging with companies on the risk side of the equation, of course is relevant, and of course it's important. But it doesn't chime with a lot of their behavioral incentives. And I really believe that if we're going to reinvent, what's the other word? Reinvent and?
Renew.
Reinvent and renew stewardship. Mm-hmm. Investors and agents of stewardship need to think very actively about how to engage with issuers on the return side of this piece. And I think there are really interesting ways in which that can be done. And maybe we'll keep some of that for the conversation. So I'll stop there.
Thank you, Alex. So definitely something to look for later on in the conversation. So I will now ask each and everyone in the panel a short question. In the meantime, you can also already start thinking what you want to ask, because then I will hit the floor. Alan, first. So you had a bit of a grim look at the topic. You raised the issue of conflicts of interest. And I think I need some more juice there. So can you give a good example, some really prominent example on where this surfaces?
Well, I'm going to be a bit cheeky and point to an example that you and I both encountered a couple years ago in this very room, Rob. We both got in trouble with a major asset manager. Yes. I believe she called you, what, an annoying irritant? What did he call you?
No, an annoying antagonist.
Oh, okay. Yeah. Annoying antagonist. Okay. So this is there's a reason
maybe
for this.
Can you explain what was going on there? Because the audience is totally confused right now.
So literally all we did, I mean, this is very innocent of us, Rob. Mm-hmm. All we asked about was about conflicts of interest to a panel that included a major asset manager. And just the asking of that question produced, I think, quite an extreme response. And I'll just explain, I'll give you the juice, because I think it's important to pick apart the reasons that we see these conflicts of interest, and they come from several different elements. One is what Alex talked about, it's this focus on returns, right? So that incentivizes a lot of the more useless activity that we see in the ESG space. If you can trade a bit more, you can usually charge higher fees. Some people have said that ESG has saved asset active management. So there's in general, you can charge higher fees on ESG products than even active vanilla products. That's, I think, a little less true now, but definitely was the case for the first few years of this industry. So that's one piece. But beyond that, you have to look at what they're trying to do. They're asset gathering, right? Even if you can charge the maximum in terms of fees per unit, you need a lot of units to really make a lot of money in asset management. So it's that asset gathering function that is going to dominate, and you can't afford to anger the companies whose pension funds you want to manage. And that shows up really clearly in the data. You've got a lot of hesitancy specifically with the parent companies of the pension funds that these asset managers manage. And then finally, you've just got like a cost function. Like what would get you to charge more and make yourself a little bit less attractive to your potential client base by engaging in a stewardship activity, in good faith, that simply cost you money, but that allowed everyone else to benefit from what you managed to do, if you got anything done from the stewardship activity in the first place, which is a big question. So basically, it's one of those classic free rider problems. If you're an asset owner, you have to think in the longer term, and you have to think about absolute values, right? If you're an asset manager, you're just thinking about how you're performing relative to your competitors. It's outperformance, it's all that. If you're an asset owner, you have to pay out to your beneficiaries in 30, 40 years' time in absolute terms. So you can't afford to have the whole system become depressed because of externalities manifesting themselves. You actually have a real interest in the health of the system as a whole. So your stewardship activities, it can even cost you a fair amount if you think that the activities that are happening now could really impair your chances of performing your sacred duty, which is to pay out to those beneficiaries in many decades' time. So it's just a completely different set of incentives and interests, and it plays out perfectly when you look at the data.
Okay, thanks. So, sort of related to the question I'm going to ask Catherine. So, Catherine, you said there was this elements of a perfect, let's say, and future-proof stewardship activity, which starts with building of power, you said. You said building of power is really important. But who is in that coalition then? Who do you want in there, and how do you build this coalition so that it is going to be effective?
Oh, I'm just going to speak here. So my definition of power is the ability to act. So you just need enough power, enough investors together, so that when you open a dialogue with a company to raise an issue or of concern, of interest to the investors in that group, you've got enough of them that they get a hearing. Actually, there's no real science to that in my experience as a practitioner. So you can have massive coalitions that are a bit confused and internally conflicted, and where quite a lot of the participants don't really want to make anything really happen. Those actually, despite the fact that like AUM, asset under management, on the box looks really good, they're less effective because it's better to have a smaller group that's really focused and have totally agreed what they want to get done. But again, this is drawing on my own experience at Share Action of pulling these groupings together over many years. The best and most interesting coalitions have blocks of power to open a dialogue and be an effective, collaborative, collective steward of a company, include some asset owners, some asset managers that perhaps have chunky holdings, but only if they're prepared to escalate and see the process through. And if you want to deploy tactics like a shareholder resolution, at least for in the UK, that's subject to the Companies Act requirements, and unless you've got 5% of the shareholder capital of the given company, you need 100 participating investors. So it's very difficult to get 100 institutional investors. So typically in those groupings actually have a whole lot of little retail investors as well as institutional investors. So it's a mix, but what's really important is that the group have had the preliminary conversations that make them coherent in the asks they make of companies and in the dialogue, and that ideally they build trust. And again, it's a very relational business, stewardship. It's relational between the investors and the companies. Trust must emerge, but also between the participating investors in a collaborative initiative. But where those conditions are met, where you have a group which might be a mix of asset managers, asset owners, and even retail investors, and they really know what they're trying to convey, they know what they're asking for, and they know why, my experience is it can be really effective and does deliver results.
So do I understand that you essentially did not yet lose faith in the asset managers in building those coalitions?
No, of course I haven't lost faith in asset managers.
Should have brought
but
one.
I think asset managers are in a really tricky spot right now, because on top of all the conflicts that Ellen has just described, and which are well documented in the academic evidence, there's a new set of conflicts between the fact that in this era of US highly politicized context for this type of work, you've got, previously you just had conflicts mainly expressed in the corporate pension fund community, but now you've got all these Republican public sector pension schemes that have said ESG is a really bad thing, and we're not going to have any of it, and we're definitely not going to be doing business with asset managers do that. And those same asset managers, poor things, have got business coming from other asset owners who are really up for all of this. So no, it's a mess right now. And it'll be really interesting to see how it plays out. But I think you might see a sort of sorting where asset owners that are really interested in the management of externalities, and they want their investee companies to behave in a way that's consistent with things like decarbonisation of the economy and the management of decent labour practices and so on. They're going to have to crowd into a set of asset managers that deliver that from a stewardship point of view. Because what we're definitely seeing is a retreat from commitment on this from managers, asset managers that have a lot of business in the US amongst institutions that have become way more political on the asset owner side around this whole agenda.
Thanks. David, you talked about the asset owner perspective, so the trustees, for instance, and you said, if I quote you correctly, that they essentially have to achieve investment goals that are written in the law, exactly how it's done, financial goals, but they should take into account systemic risks. What does the law say what exactly a systemic risk is? And would, for instance, let's say, human rights related topics count as systemic risk, or is that just idiosyncratic?
So, I don't think the law has a definition of systemic risk. What the law wants asset owners to be doing is to consider any risk that has a potential bearing on their success in achieving the objective that they've been set by law, which for pension trustees is ultimately to pay a pension. And certain systemic risks like climate change, there is now probably sufficiently credible scientific evidence to show that climate change will have an impact over a relevant time frame on trustees' likelihood of achieving that goal. So it is a relevant risk. I call it systemic because to distinguish it from idiosyncratic. In other words, it is to do with the performance of the economic system on which investors rely and companies rely to achieve their goals. It is not specific to the performance of an individual company, like an individual company could change its position to reduce the likelihood of litigation risk, but its doing that wouldn't necessarily tackle systemic risk in any way. That would be an idiosyncratic step. It could be both. It could help.
So, but does that mean that, for instance, human rights, which
Yeah.
is a topic that relates to inequality in,
Yeah.
and for instance, in a country,
Yeah.
that leads to a lot of, difficulties in that country, could be also a systemic risk?
Well,
if
I
you
think
compare?
that's where we get into some quite interesting discussions, isn't it? Because, let's just deal with climate change briefly. The agenda, if you accept that climate change is a material risk to the performance of your pension fund, the workload in responding adequately to that alone is massive before we even get on to social factors. However, the question is, could social factors be systemic? And the answer, I guess, has to be yes. And a perfect example of that is people movements, which is a crossover between climate change and social issues. We can already see the impact that people movements are having on political stability and then, in due turn, economic stability. If climate change continues to aggravate that, and there is perfectly credible evidence that climate change is aggravating it at the moment. If it continues, then yes, we've clearly got a social issue that is relevant to the systemic threat that climate change poses to economic systems.
Okay, we will definitely come back to this, and I see Catherine wants to say something. Do you really want to chip in already or not?
I just wanted to ask David about, can I?
Yeah, go ahead. Go ahead.
So obviously for a defined benefit pension fund, you have an obligation as a trustee to pay out the pension, which is defined within the rules of that scheme. But for a defined contribution pension scheme, and most people in this country now belong to them, you've got a fiduciary duty to invest prudently for the members of that scheme, and to do your very best to invest in a way that deliver them a decent income, and that income hopefully will be, at a meaningful, will be able to purchase a meaningful standard of living in retirement. But you don't have a duty to pay a particular pension. You've just got sort of a best efforts, and that's why I think, you're not going to be liable to pay out a particular level of income. You just, the members put the money in, and you invest in, they'll draw what's available when they retire. And so I do think that the need for trustees in those circumstances to think about the behavior of those companies and to steward them in a way that delivers the best overall portfolio return, and does so in a way where those companies aren't operating in ways that are damaging the financial and, in my view, non-financial interests of the members of the scheme. It's a sort of slightly different beast in terms of the legal situation, is it not?
I'm not. I think you sound like you're saying the same as me, because essentially, if the obligation, the purpose, so pension trustees' duties essentially are to achieve the purpose of the trust, and the purpose of the trust is to pay a pension, and therefore everything, their duties, the powers that they're given, have to be focused on the purpose of the trust. So if what you're saying is they need to do what they can to discharge that duty to provide a pension for their members, then yes, systemic threats and any other threats that are relevant to that come into it. Or am I misunderstanding?
No, well, it's a very specific amount of money that has to be paid out in one
Yes, it's different from a DB scheme.
And it just isn't. It's like there's no real number against it for
Yes.
DC. And so, in my view, it's sort of really need to think about, well, as you invest over decades for those people, what are the returns being generated from the investments, and what are the impacts of those investments upon the future living standards and quality of life of those people? It's just...
Well, the purpose of a pension trust is not to preserve the living standards more widely or to protect the world into which pensioners exist. That is not the reason that pension trusts are set up. They're set up to pay a pension. So if what we're saying is that pension trustees have a duty to secure, as well as providing a pension, to secure the world into which people retire, I think that is one step ahead, certainly on my understanding, the understanding of most of the pension lawyers
So I think,
know.
David, at some point in the summer, you really should come to the Netherlands and read what the Dutch funds write, what their purpose is. And so it already shows how different per country those purposes are being defined. Because a lot of Dutch funds write, literally in their investment beliefs, we want to have a good pension and contribute to a better world with our investments.
Yeah.
So, and that is the interesting thing of that, is that Dutch investors are also investing in UK companies, and UK investors are investing in Dutch companies and US, etc.
It is true, Rob, that there is a degree of variation. I authored a report called A Legal Framework for Impact that looked at this question across 11 jurisdictions, including the US, the EU, and specifically we looked at the Netherlands, where the situation is probably the most liberal on this. And it does give quite a lot of leeway for pension trustees in the Netherlands to pursue in parallel with financial objectives what you could describe as sustainability objectives.
Which also has a lot of dangers coming with that, by the way, if you have that leeway. But Alan, is it really important? Because Alex is sort of...
It's just like two seconds, just because I think there's a way in which these things shade together, and I'm just kind of making this up right now, but there are a lot of potential inflationary threats that come from climate change and other systemic risks. So if you're trying to translate what would be like an okay pension into purchasing power that is terrible because of all these other things that actually the company's externalities have caused, that then shades into...
So if what we're talking about is the provision of the pension and a pension that has got adequate purchasing power, then we're talking... But if we are talking about securing a world in which a particular pension has purchasing power, then that seems to me to go beyond what trustees are...
But those two things are connected if you end up
They're
with
connected,
all these...
yes. So in taking steps to try to tackle systemic risk to the financial system, you might well be contributing to a world that is more pleasant for pensioners to retire into. Absolutely. But the motivation critically has to be the purpose of the trust. You can't be motivated by some ulterior purpose.
So I'm not sure whether this is on. Can you please... Oh, there we are. Okay, thank you for the introduction. Alice just said, you have to go to the audience. He saw a few already raising their hands. Where is my... Can you please go there first? Was the first? Jacco from FTSE, I know.
Yeah, London Stock Exchange Group and FTSE Russell as well.
Please, short questions or comments. No long essays.
Two quick questions.
Yeah.
So, is there a possibility that, part of what the stewardship function does is enable you to stay invested in companies that perhaps, if you look at your sustainability policies, you shouldn't stay invested in? And so is that perhaps one of the tensions? And the second question is is there also a malaise, or is this malaise also partially caused by poor stewardship arguments? So there's always this underlying assumption that everything that stewardship teams say to companies is good advice. Is that indeed the case? So when we're looking, for example, at an oil company to sign up to Net Zero 2050 and invest heavily into, let's say, solar panel business, is that really, from a company's perspective, what the company should be doing? And is that maybe also part of what is causing this problem around stewardship, that it's very simplified cookie-cutter messaging to companies that maybe isn't that relevant or beneficial to them?
Who wants to start? Alex?
Yeah, thanks. Maybe I'll take that second question first. Well, take that second question. And sort of at risk of being a bit reductive, you can look at the stewardship from an issuer's point of view. You can sort of look at stewardship and saying, well, if I listen and do what's being advised, that's sort of objectively good for me in the company. either in terms of sales or profits or valuation. Conversely, if I don't listen to what's being said, that's kind of objectively bad for me in terms of sales or profits or valuation, right? And that would be a kind of apex to act on what comes to you. I would argue that the case of not listening equals being bad for me isn't very well made, right? I would argue, and this is my own personal view. I don't think issuers are going, damn, if I'd listened to those guys more, life would, so on that downside risk, I think it's kind of capped. But I think the opportunity, if I may say that, the opportunity for stewards acting through the investment manager to say X, Y, and Z could be good and is demonstrated to be good, and whatever that benefit is aligned with the objectives of the steward as well. That is the opportunity. To make one related comment, we often think about stewards as being exogenous to the company. It's not the case. I work in water as my discipline. And within every company, there are groups of people whose job it is, and that is to manage how the company engages with water resources in a food and beverage company or whatever it is. And I go to these guys and say, well, why aren't you doing more as a company? And they say, well, we've got to make the case to the C-suite and our own management and get them to kind of allocate proper capital to, capex and whatnot. And we really struggle to make that case, because the case we make is a risk mitigation case as opposed to a return enhancement case. Or I say to them, you don't make a return enhancement case. But there is a return enhancement case to be made. And we can go into this. And I think this is part of what is missing in this discussion, right? We frame a lot of this discussion as in what's bad if you don't do X, Y, and Z, as opposed to what can be good in a way that incentives are aligned if you do X, Y, and Z. And I think that if we are reinventing this thing, we live in a much more transactional landscape today than we did 2 years, 5 years, 8 years ago. And that presents opportunity.
Okay. Any other comment on the question? Or Alan?
I would just observe really quickly that often divestment and stewardship are presented as alternatives to each other, and stewardship is often used as the excuse not to divest. I always ask as a follow-up, okay, so you're engaging with all of the companies then? And usually actually the answer is no, which kind of shows that it's being used as an excuse. Whereas I would actually argue that these two things are both stronger together. The results are more likely to be effective in combination than either one of them alone.
I would totally endorse that, but also sequentially. So what you want to do is start with an ask of a company where you see an objective that needs to be met that isn't being met in your interest as an investor, and use the tools. And there's an extensive toolkit available: votes for directors, shareholder resolutions, much softer private dialogue and discussion where you have a good chat and you really bring the case. But if none of that is working, then you absolutely, I think, need to consider moving your capital out of that company ultimately, as a way of, that's part of stewardship, I'd say. And all too often, as you're alluding to, and as you've just said, investors stay in this kind of quite pointless loop where we're having a dialogue, but it's not going anywhere, and we're not creating consequences for that. So that's what is very poor practice, I think, and quite, unfortunately, quite widespread.
Okay. So I forgot to talk about the rules. And the rules are short questions and one question. So think about the question you want to ask, not 2, not 3, no comments. You can make comments, but then that's it. Then we go to the next. Because we want to have everybody involved. So please go ahead.
Thank you. Well, I'll try it. Tony Greenham from the British Business Bank. We're actually a venture capital investor, and I want to pick up on Alex's point on being returns focused. And what we're seeing in the VC space is very much venture capital investors focusing on ESG as a value driver. So I would point you to Antler VC, for example, does a great survey. And so, I mean, these are by definition active owners. So I guess if we're in a stewardship recession in the world of public markets, should we put lots of effort now into private markets and particularly venture? Because that's where the companies of tomorrow are being built.
Who?
I just want to really quickly say, if you're worried about climate change, there are 57 companies that account for 80% of the fossil fuel and cement related emissions. So like, we should do lots of good things with smaller companies, but actually it is halting fossil fuel expansion on the part of these very large actors that's the main thing. It actually gives us a real focus. It's a small number of companies that we need to focus on.
I mean, super briefly, short answer, yes. Slightly longer answer. I'm probably less optimistic of the stick side of divestment. Not because I don't think it's ethically and logically the right thing to do. I just think at the margin it's. But I think talking to exactly what you say, of thinking where the alignment of objective and agency is at its highest, is where at the margin you'll have the most incremental effect of change, and you're changing today the outcomes you want to see tomorrow, which is exactly the point that I think you're making. So yes.
I would just add to that, we endlessly talk about divestment, but what about, when you've had a good stewardship result and you've seen these companies really responding and doing the right thing, allocating more capital into them, rewarding them, would be just great to see more of that in the market.
So just to manage the expectation of people who want to ask a question. First here, then there, then we go there, and then maybe at the back. So I'm seeing you all, yeah, and there as well. So first, keep it short.
Hi everyone, I'm Laura from the Church of England Pensions Board. I just wanted to ask, so there's been a lot of consensus about the fact that we're in a tricky spot with stewardship, but we also, a lot of consensus that asset owners like the one that I work for should absolutely be acting on systemic risks. How do we do this now? What is the high impact activities, actions that we should be taking to actually do something meaningful about systemic risks now, given we're in this tricky spot?
Thank you. Yeah.
I think well, this is only a partial answer, and you probably have a more sophisticated one. But I do think that the asset owners in particular have to think about where they're allocating capital in terms of which asset managers. If we're serious about this, we must reward it through the allocation of mandates to managers that are focused in a serious way at the 57 companies. Was it 57? Yeah. And really have a robust evidence base around process. To use you talked about, that's what it takes, because you can't always see instantly those. This is a conviction position, but also rationally based on evidence process. And so I really very much think that the pension fund community, the world, that are really serious about these systemic risks have to figure out how they use their power more effectively in the allocation of capital into certain managers that are serious and have a track record in this area.
But why not do the following then? All of you asset managers, asset owners, you just take these passive mandates and you fully concentrate on the filing, voting, and engagement collaboratively with just the asset owners, because they're not conflicted most of the times. Why don't you do that? And then you have some spare time to do some VC at the same time. Why is that not an option?
Honestly, I'm sympathetic to that. I mean, frankly, any illusion that you have that you're not diversified anyway, I mean, we're all diversified. It's just the degree to which that's the case, and therefore we're vulnerable to systemic risks. Just to answer Laura's question, classic Laura question, we've decided at Cambridge to focus on the following things, because that is exactly our lens. So we don't bother with engagements with individual companies other than banks and asset managers, because, and then we've started to actually salami slice away from the ones who are non-compliant products and services. So we're combining divestment and engagement in everything that we're doing. But you have to look at the activities of those entities in the round. So we assess them on the basis of, are you contributing primary market capital to fossil fuel expansion? That's the big one. including infrastructure in the power sector? And then for the asset managers, are you voting against the re-election of directors of companies that are engaging in those activities? So we keep it really clean, really simple, really high impact, where the vast majority of the issue is, and then we're using the strongest tools that the evidence suggests there are. So there aren't a lot of studies on director votes, but actually at much lower levels you start to see a response from companies, because it's embarrassing to high status people, basically.
So there's the next question, but before we go there, is there an asset manager in the room that wants to ask a question to the panel? Is that you? We do that first.
Thank you. My name is Abdul and I work for Meridian Investment Management. To Alex, we're a very active investment manager, 90% active share, no benchmark hugging, so I don't appreciate the passive comment, Rob. I guess my question is, specifically to you, Ellen, you said you don't think you believe in engagement anymore based on the studies that you've seen. Maybe does that have to do with the fact that engagement at most big asset managers is done by a separate ESG team that knows nothing about the company? You know, I've heard companies tell me when we engage with them that the portfolio managers, the equity analysts tell them one thing, the engagement team tells them a completely different thing. And it's very hard to understand the business model of a single equity. So don't convince me you can understand the ESG realm and the equity realm together. So I'm guessing my question to you is, do you believe that these studies are biased by looking at these types of asset managers? And I guess my second question is, sorry, I know the second question is related comment is, your title is Responsible Investment Advisor. So I guess my question to you is, as well, is what does responsible investment look like to you if it's not engagement, if that makes sense?
This is a very targeted question to you, Ellen.
Yeah, great questions. So the first is, I think you've pointed to some of the problems with stewardship as it is, but frankly, as long as the goals are to get kind of crappy information voluntarily out of companies, which describes the vast majority of stewardship activity currently, it doesn't matter how sophisticated those arguments that are being made are. And the other thing is, like, even if you had really detailed company-specific knowledge of the business model, that's still going to conclude that externalities are profitable. I mean, there's a reason that companies aren't paying for the negative impacts that they're having, and it's because, especially for the highest impact companies, you would destroy the business model if you actually addressed the externalities. So I think that's a fundamental conflict, but then that does lead you to the next question that you asked, which is, you know, what should asset owners be doing? And we have to think systemically. There's no way around it. So that means probably a lot of direct engagement with governments to try to counteract some of the lobbying activity on the part of the companies. By the way, the lobbying activity is happening on the part of companies in which they are shareholders or bondholders, and they're contributing to trade associations that are also distorting the political landscape in which we operate. And those are against the interests of asset owners, and they actually have direct levers over all of those things. So a lot of the activity that we're doing in stewardship does not fall into those categories. It's like individual companies asking them for more information. So it's kind of a combination of the issues that you pointed out, I would say.
Okay, thank you. So we continue here.
Hi, my name is Christian Schütz. I work for Golden Capital. We are an asset manager in private markets. I'm curious, listening to you, David, and also to you, Alan, the discussion that we are having tends to always come back to the pension trustees' responsibility and the question of their fiduciary duty and whether or not the world that the pension receivers ultimately will retire into is worth living. So is there any hope that we clarify that position from a legislative perspective? You pointed to the Netherlands where this mandate is much more clearer. If you read it a bit differently in the UK, you could look at some signs where also there the mandate might be there. In Germany, you can also find it in law. So what's holding us in these debates back of pushing that argument stronger, and what else would we need from legislation?
Well, being perfectly frank, I think what's holding us in the debate is a lot of people who don't realize how relevant to financial risk a lot of sustainability factors actually are, and who have also got a desire to address sustainability factors that isn't financial, and who, not realizing that legal duties already are prompting trustees to tackle quite a few of these issues, look beyond fiduciary duties, or look beyond the financial dimension to fiduciary duties to try to find little loopholes and grounds on which trustees should be attacking what we call in legal framework for impact ultimate ends goals, not financial goals. Now, in all of the jurisdictions we looked at, and for most investors, there are limited circumstances where they can do that sort of thing. But it's not the main focus of where the rules are directing trustees. And if they get taken up on those sorts of issues, they really are missing the main game. And they're not only missing the main legal game, which in the case of trustees is pension, but they are also at risk of essentially mischaracterizing sustainability activity that they're engaging in. And I think we've seen this in some of the US cases recently, where there's been discovery of the grounds on which investors or investment managers have been doing things, and they've described it in ways that don't lock it back into the financial goals that they've been given. And there is no coherent explanation of how some of this activity is supposed to relate to the financial goals. And when you do that, you increase your legal risk. I'm not saying that there are never circumstances in which legal duties would allow you to tackle wider goals, but the circumstances where financial duties are already prompting you in that direction are so extensive, I would suggest, that really it is the main game. And we shouldn't be spending lots and lots of time trying to broaden out these little exceptions. Certainly in the UK, they're small exceptions. I accept in the Netherlands it is a rather broader discretion. So, I mean, does that answer your question? Yeah.
So before we go to Catherine, because you know, and Alex, what is not clear to me, you just talked about what they do and may not be in line with what they should do, but you can also look at what they don't do. So suppose I'm a fiduciary, big fund, but I don't do any stewardship activity on climate change related stuff. I have my portfolio that is climate risk proof according to some data provider, but I don't file resolutions to companies that I own. Am I liable?
Well, I think a court faced with that question would look at why you are not doing it. Mm-hmm. And they would look at the process that you've been through, what decisions you have taken or failed to consider and failed to take. If you have failed to consider things and failed to take a decision, you're just sort of by
the audit trail is perfect, you know. All the meetings they say.
If you've got a perfect paper train and you've got a coherent reason as to why you're not doing it, I think these days a court would be rather suspicious, but they would be quite hesitant about stepping into the position of the trustees and trying to second guess the decisions that they should have made. Okay. I think you would be in a rather risky position if you really hadn't considered it properly, but if you have considered it coherently and you've got robust reasons for doing what you're doing, I think a court would.
And a robust, grounded reason, as you called it, might be, for instance, we don't have the resources for that?
Yeah, so, and this question came up, in fact, in a recent conference, because we had there was a pension fund trustee, and it was, you know, two people and a budgerigar, really, and it was very difficult for them, and I think the answer at that point is, well, have you got an investment manager, and what's the investment manager doing? You know, there is always potentially a dimension to approaching this.
Yeah, it's shaky ground, it's the expression. Catherine.
So, I mean, what's already emerged in the discussion is that the law is somewhat different in different jurisdictions, and the Netherlands has a more has a legal regime for pension schemes where trustees and boards have more discretion to act on sustainability factors for ultimate ends, and there's a little bit more. But there's a little bit less space for that in the UK and less still in the US. So there's a hodgepodge around the world, and here in the UK, where we have a very big pension fund industry with a lot of assets and therefore a lot of potential to have a positive impact on these things, it's my long-held view that it would be really helpful if the law were clarified, exactly as you've said. And there is pensions legislation starting its journey through Parliament right now, Pension Schemes Bill, and Share Action, where I work, has been collaborating with a wide range of people on the development and drafting of an amendment precisely to clarify the law in a way that I think would give more legal comfort to trustees that in acting to discharge their duties, they would not put themselves in a legally problematic position if they were to really engage robustly as stewards to tackle systemic risks, for example, where that had uncertain outcomes on the financial position of the scheme, but where it was all contributing to the resolution of those systemic problems. And so I think I'm very sympathetic to what you say and see the need for it personally.
Okay. Thanks. Alex, you also want to follow?
I just want to briefly go back to the question from you, sir, now on your phone, sadly, but...
Well, you know, always have to check what the markets are doing, don't you? Yeah.
To go back to the question that you raised and just the dialogue on the back of that. So I, for one, think, and I think we probably all agree, that stewardship is and should be much more than getting companies to price externalities that they don't want to price. And if that was what stewardship, and you weren't saying that, Alan, but if that was what stewardship was, that's a pretty, you know, that's a tough sell. Where I am very, very sympathetic to what you're saying is this separation between the jobs that investment managers do, where they understand companies and they understand the opportunity for the company and the risk for the companies, and the companies themselves, who I think understand the opportunities for the companies and the risks for the companies. And I have got very frustrated with the conversation from the stewardship community writ large, which seems to assume that they somehow understand things that the companies don't get. And it is hubristic and wrong. Catherine is exceptional. I've known her a very long time.
And you sit next to her.
She is exceptional. But she's exceptional because she does her work. She does her work. I think if you take stewardship people into these conversations where they don't fundamentally understand the investment case for the company, what are the risks? What are the opportunities? How can the risks be mitigated? How can the returns be enhanced? Fundamentally understand that. There is a limit to how much respect and traction they will get. I give you the analogy of a sell-side analyst. And the job of the sell-side analyst is to know the company. They start with a financial model. They work from the financial model to think about the investment case, the management case. The good analyst will make suggestions or recommendations. If company X considers doing X, Y, and Z in its strategy or in its operations or in its financial management, they might expect to have outcome A, B, and C. And if they fail to do X, Y, and Z, the risk is they may have outcome C, D, and E. And that's what that's where the sell side adds value. A good bit of paper like that you then read. Stewardship should be exactly the same, except you take that same investment case framing and you apply the lens of the things that matter in your mandate as a steward to make those recommendations. It's not this assumption that companies are somehow too stupid to understand stewardship and it needs to be explained to them is exactly why we're in second gear in this thing. Companies are smart, investors are smart. Stewards can be super smart, but you have to do the work. You can't just say, well, we're talking for X trillion dollars of AUM and so that's gonna figure. It just doesn't, right? And I think this is where this kind of grown-up conversation, and thank you for having the buy side in here, because I think you guys, we instinctively get this, and most people who work in the street instinctively get it. I just think the stewardship community has kind of, it mushroomed in that sort of sustainability re-rating that we've had over the last 10 years. And a whole bunch of people came into this stuff, and they just don't do the work. And they just think it's enough to say, I'm doing stewardship, you need to kind of figure it, you kind of need to listen to me. Without doing the fundamental work of you don't get any respect from the issue. Get the issue as respect, and they will listen. I've seen sell-side analysts putting full sell notes. The CEO will always take the call, not just to lambast, because they know these guys have thought about the issues. They don't have to agree with you to listen to you, and they don't have to agree with you to act on what you have to say. So thanks for making the point.
This is recorded, we don't hear you now, and also the people later, sorry. Thank you for the passion, Alex. Let's go to over here, Genevieve.
Okay, so starting in the early 2000s, we go with GRI, PRI, TCFD, SASB. These are all frameworks that it says in IFRS, the International Financial Reporting Standards, that if you call them out in your financial statements, in your sustainability reports, in your earnings call, you are literally required underneath accounting law to meet each of the requirements. You don't get to choose. You're required, right? And then, here's the interesting thing. Ever since the early 2000s, okay, there's been over 5 releases to the auditors, specifically calling out that if you're reviewing sustainability-related data, you specifically have to look at each of the frameworks, each of the requirements, and you have to make sure that they did each of those different things. Why do you think that the industry didn't do that? And do you think that that's fair?
That's a clear question. I think this is a question for Alex, given the passion you just had. I'm just kidding, Alex. No. So, okay.
I don't know.
Yeah, go ahead.
I have no idea.
No idea?
I mean, there's a lot of things in this world that are technically legal requirements and they're just not enforced, and that's a big fat bunch of them you just called out. But you know, you're very much right to point out that's another set of tools, if you like, or another set of opportunities to identify concerns of a sustainability-related nature that maybe aren't being addressed by companies. But just because it's a requirement somewhere doesn't mean it happens, because it's not enforced and there are contrary motivations and incentives elsewhere that are acting against that. But I would actually love your answer to that question, if you want to, having posed the question, answer it. I don't know.
So, do you have a short answer to this? Yes, I can give you the mic, no worries.
Nice.
Because the people in this room aren't writing to the regulators and requiring for them to mandate it. That's why. And you have to not stop. That's it. You have to not stop. You have to sit there and say it's not okay. This is law. That's it. I'm sorry. It's not fair. We are going to breach 1.5 degrees by 2030. We know that. We know that we are expected to breach 2 degrees between 2040 and 2045, and potentially 3 degrees by 2060. And those have massive ramifications to this planet. That is unfair to every child. It is unfair to any grandchild. It's unfair to any of us. It's not okay. And it's going to cost over $100 trillion to fix the existing built environment around us. And who's going to pay for that? And what about all the additional insurance that we've been paying? Right? Do we get compensated for that when people are about to lose their house? Who's going to compensate us for that? And when the funds crash, who's going to compensate us for that?
Thank you.
I mean, it would be interesting, David, to talk about the liability perspective on all of this.
Can you?
Who is liable?
That was this morning's session, I think.
Oh, okay.
Litigation liability.
Okay, we continue. You want to respond?
Could I
Yeah,
say
go
something?
ahead.
Because actually, like, if we had conversations in the stewardship space that had the level of urgency that question, that answer gave us, I think things would look different. Right now, we're like falsely reassuring ourselves, like we're doing it right now. We're having a very calm conversation while watching everything burn, quite literally often. And I think that's part of it. I ended up quitting a bunch of collective engagements through an unnamed coalition of shareholders because I actually couldn't, my soul couldn't handle all these polite conversations, this tummy tickling conversation.
And the plus is that you have more free time.
Yeah, more free time.
Okay. Go ahead.
Thank you. Tim Yeomans, former large asset managers engagement director, now independent advisor on engagement. So recently in the US, new guidance from the SEC on what's called 13D and 13G has caused the largest asset owners, the largest holders, largest voters of almost every major corporation to purposely and intentionally pull back on their stewardship efforts. Meaning, in summary and oversimplifying, not asking companies to do anything, to make any changes, and saying that even, and reading disclaimers, and even saying that any of their conversations they have with companies don't affect their director votes. So intentional pullback of the biggest, BlackRock, Vanguard, State Street, Fidelity, and similar in their stewardship activities. What does the panel think will be the learnings, successes, and failures that we get from this intentional pullback on stewardship and engagement by the largest asset managers? Thank you.
Catherine, I think.
Well, I think it's a travesty, obviously, because I think if you are an asset manager that controls votes on behalf of clients, you should be free to do that in a way that's in the client's interest. And there's a sort of SEC ruling, or it's not even a ruling actually, it's a guidance now, I think, that has totally killed dead. Oh, but by the way, the trend was already there, as you know, in terms of the kind of pullback on the purposeful use of the vote. The question for me is what then follows, and what are the implications for all of the asset owners that have business with managers that are being guided in their actions by that guidance. And what are the implications for those with fiduciary duties who think stewardship is a part of that fiduciary duty and who allocate and mandates to certain managers? I think it's, my own view is that it poses really interesting questions for asset owners on this side of the Atlantic and all over the world who use those managers, because it's just a fat contradiction between what they're saying in their investment beliefs and their investment policies and the use of those managers. So it's very challenging. I'm not saying it's simple, but there's a small number of high-profile examples where you've seen a pull away from the managers you've just mentioned. But on the whole, most asset owners are just kind of watching and waiting, and I think are being, talking of passive, quite passive in the face of this. But I think we might, you might start to see momentum build, and I think it's very important that stakeholders of those asset owners, including members of the pension schemes concerned, do challenge and ask questions. They're valid questions for boards.
David also wants to respond?
I just wanted to highlight that the situation's even more complex. It isn't really just about passive investment managers, because what they've done is essentially change the definition of what an activist investor is. So that essentially if you're doing something like saying that we'll withhold our vote for a board member unless you adopt a particular transition plan, that now would, in the SEC's view, count as being an activist investor, which then pulls you into a very onerous reporting regime. It's compliable with in theory, but it is extremely onerous. And the trigger is a 5% holding in the company, and you think, well, 5% holding, that's quite a big amount of votes to be exercising, but there's an aggregation rule. So that if you are acting in concert, essentially, with other investors, define who decides what's in concert, then you are potentially caught. So if you're a bunch of European asset managers talking about exercising your votes in Exxon, potentially you get pulled into this regime as well. So it is an extremely complex situation. On pulling back from investment managers, such as the famous case, it was the People's Pension, I think, pulled out of BlackRock. We have to bear in mind that these mandates only come up for renewal every 3, 4, 5 years, and breaking into a mandate in the middle of while it's running, it's a very, very big exercise to start renegotiating a mandate. So I think we may see more as mandates come up for renewal.
Just small response.
Just a quick response from the companies. In my thousands of engagements, the most recent cohort, universally all the companies say this is a bad thing because they value the change, suggestion, input of their largest holders and voters.
Could I just add one thing, which is that those largest asset managers, actually the evidence suggests their conflicts of interest are even worse. Like their voting was, before any of this, worse than their active competitors. So I think your question kind of assumes that they were doing something useful in the first place, and I don't think they were. And their engagement goals were pretty much all disclosure-based anyway. So I think very little has changed other than maybe a little bit of talk in the media.
We're over there. Yes, go ahead.
Thank you. David Fischer from Munich Re. I was wondering whether you think let's say the events that we've seen in the United States, especially breaking down of several alliances of asset owners, asset managers, banks, etc., on the basis often of the risk of being sued for maybe collusion or other legal reasons. Is that the emergence of a new anti-climate litigation risk in that sense, and therefore the end to collective stewardship and engagement? Or is this just a political blip in history in the end? Because I think that's the core question that a lot of boards right now ask themselves. To what extent is this really a material risk, and do we need to react?
Yes, David.
I mean, it's clearly proving extremely challenging. And one senses it's been building behind the scenes for a long time. And in all honesty, I think it's caught a lot of people unawares. And I don't think people had done sufficient homework to be ready to respond straight off the bat. And people are having to revisit what they're doing to try to work out how to navigate it legally and safely. We may see the pendulum swing back the other way, but we can't assume it. So, I think it's causing a lot of fallout. Quite possibly what will emerge will be a much more rigorous, well-grounded product in the end.
Next, over here.
Thank you. My name is Dhruva. I come from India. I work for a sustainability think tank, and I'm an academic, a professor. I teach sustainability in business schools. My question is very specific. Fiduciary, historically, or rather stewardship was a fiduciary duty. Typically, and Alex sort of crystallized it by saying, today we want fiduciary and addressing systemic externalities which the society or the country faces on stewardship. I think there is a conflict, and I'm seeking your opinion here, that do you think stewardship is likely to fade away in this? There is not only one conflict, but I can name 10 more conflicts that the world is today faced with. Private versus public capital, nationalism versus multilateralism. You can take it as guns versus butter too in classical cases. So many more conflicts are there. Now, does it mean that stewardship needs to morph into regulation for asset managers and asset owners, essentially because it's about the real sector companies they're investing in? And if it is so, then the issue is the incentives of just return is not actually the systemic risk, but it's actually most asset managers are incentivized by idiosyncratic risk because it's risk-adjusted return. So that brings me to the question that unless you monetize, you're able to monetize ESG, as you mentioned very clearly, disclosure is not getting us anywhere. ESG is not getting us anywhere. So reporting and disclosure is not working. That's quite clear. And if it is so, then does it mean that it has to be a metric in the financial statements? Because if it is not a metric in the financial statements, it will affect valuations, and we are going to continually face this shareholder capitalism versus stakeholder capitalism, not going to go anywhere. So here's my question. Thank you.
Okay. Alan, go ahead.
Sure. Just a couple of things to start with. So I'm a fan of mandatory disclosure as long as it's not like thousands of indicators, because I think there are only a few indicators that actually matter when it comes to climate change and other issues like that. So sure, included in the financial statements and so on and so forth. But I think the meat of your question really is about what sorts of entities asset owners are choosing as their engagement targets and what they are asking of those targets. So I don't think it makes sense to go to an individual company and say, hey, lose money by avoiding these activities that impose costs on all the other companies in my portfolio. Like, that's not a winning argument to that company. It's true, but it's not a winning argument. So you could do a number of different things. You could narrowly address that company's lobbying activity, which you do have some levers over. You could look at the entire sector and get them and put pressure on them all to do something so that they aren't at a competitive disadvantage. Or you could go to the policy level and enact legislation or regulation that would have the effect of producing the result that you want. But there are a bunch of different examples like that where probably the answer is not to go to an individual company and ask them nicely to do something.
Alex?
Thank you. I mean, maybe taking that comment and this comment and the last. So I mean, I might be a voice of one. I'm not and never have been a fan of investor coalitions. Just on a point of principle. In everything else investors do, they act competitively, right? The source of alpha is to do what the other guy isn't doing, basically, right? And the idea of investor coalitions saying, well, we're now talking about X trillion dollars doing that. I just personally, I've never really seen the benefit of that. So, and I know we don't agree on this.
That's okay.
And that's fine. That's controversial. But look, the logical extension of this argument, right, is if you're not acting in concert for whatever the legal challenges that may be around that or whatever else, and you're trying to do the best thing for the money you're managing, for the people you're managing it for, you will make the decisions that you should make, right? You make and people will do different things. If you're getting those decisions right, and what right means we can go into a whole big thing, you will be successful. And if part of your mandate of being successful is to make companies stronger and better and more sustainable and so on, fine. I think the investors acting in concert thing is a red herring, because I think the biggest sanction investors acting in concert seem to be able to offer is to divest. I just don't think even acting in concert, the threat of divestment is a salient enough thing to change behavior. So actually, maybe this is okay. Maybe we don't need investor coalitions to make stewardship effective. Maybe we just need smart people in stewardship who do the work, ask the right questions, give the companies a reason to change their behavior, and as a consequence, things turn out better. Could be worse, right?
Okay, so we are running out of time. Can you believe it? There's a question over there and a question at the back, and then I will conclude. Do we do a round of what we learned in this panel? No, we're going to go to divinity school.
Just give me a question.
Okay, so you first.
Sure, I'll be very brief. My name's Lou Tamio. I work on the advisory side of sustainable finance. So the point around coalition development, given sort of the recent exit from NZAM by the big players, but also NZBA, could we assume that asset managers and asset owners tend to just follow trends and they're not really serious about, sort of building coalitions? Thank you.
Alex will definitely
Can
agree.
I respond to that? Because
Catherine,
in light of Alex's mean remarks about coalitions, we can totally conclude that. There's been a lot of greenwashy, flashy coalitions where it was a marketing thing. It was like, we're going to sign up for this one and that one, and there was just so little happening under the hood. So I really welcome the fact that a lot of this is all sort of falling about and collapsing, because as I said at the very beginning, I think it's creating space for a more honest assessment of who is interested and serious. And I very much believe in collective action. I think it's always the right kind. But I don't believe in just standing coalitions that are just there to sort of signal something. I fully can subscribe to Alex's view that to be effective, I think it can add weight, definitely, to engage senior executives and board members of companies collectively, but that's no excuse for not having a really careful plan and having really done your homework and having a credible ask, having an appealing and valuable ask to make of the company backed by research. So we're probably not quite so far apart, but I have seen and believe in the power of collaborative action in capital markets.
Very briefly, because we have one question left.
I'll just say the academic evidence backs Catherine up, that coalitions do tend to produce better outcomes. Just to say, how many of those coalitions were useful, as in, did they do anything? And second point on that, to my knowledge, the asset owner coalition has actually remained pretty much intact. It's the other institutions that have massive conflicts of interest and didn't really want to do
Here we
this
are
in
again.
the first place.
Conflict of interest. Thank you. Last question over there before I conclude.
Thank you very much. Dennis West. I'm a researcher in the Oxford Net Zero Research Network. I'd like to follow up on the question of the colleague from India, from the think tank and academia. Let me just translate it into different words. What sort of user cases would you see for the valuation of impacts, not the financial valuation alone, but the impact valuation on, for example, the social cost of carbon, the damage that carbon is expressed in carbon pricing. We can do this for many other impact drivers like water, health and safety, etc. What would you say, and I'll look maybe to Catherine, in the work of stewardship, how would you use such type of impact valuation in your engagement with companies when it is about the financial value, but it is based on sound, what David Rauch mentioned, sound methodologies that have been used for some time. And I give another example, so water use, water stress. We can have water assessed in different regions, right? And it's different, the risk is different and the impact is different. Do you use such impact valuations in your engagement?
Yes, go ahead.
No, and I'd love to. So let's talk. I mean, I think there is huge scope to be more sophisticated about the evidence base to bring into these conversations. You know, we do bring in the work that we do on a range of different topics as much evidence as we can pull together. But this is why I love to be here in Oxford, because the partnerships that Share Action builds with academic researchers who are doing fabulous things that would enormously enable engagements to be more sophisticated and more credible and more appealing to companies. But you've got the water expert here, so he might want to comment on that.
Well, I'm obliged just to say, I agree with all of that. I mean, even if the stewardship community isn't doing that impact assessment, the companies are doing that assessment. This is my point. This is what I think we just not need to forget. The stewardship guys aren't the white shining knights to explain the deluded ways of companies. That work is happening in companies by very smart people who think about this very intensively. And so we just need to reframe the stewardship engagement with issuers point to the idea of comparative advantage. Where is the comparative advantage where stewards are acting on behalf of asset owners, intermediate through into investment managers? Where is the marginal value the highest for that point of engagement? Where is the marginal value the highest for internal stewardship engagement? And to what extent can investors signal to the management of those companies how and why they should be engaging internally with that stewardship process more effectively? This is not that difficult. We can get locked up in this whole legislative thing, but actually most of us are trying to do the same thing here. We're trying to see companies run better, be more sustainable, be more profitable, be part of improved outcomes. The tools sit within the system today. It's just the transference mechanisms and the signaling that could be enhanced and improved.
Thank you. Last response?
Yeah, I mean, I don't disagree with any of that, except to highlight that we've slipped into economic language and the law doesn't operate like that. And the law is not the final arbiter on this, but it is an extremely important element in the equation. And the law, I think, would embrace what you've just said, but goes beyond it. So the scope for action, the scope for the sort of discussions that people can be having, especially when you get into systemic threats, is wider, and the goals and ends that companies and investors can be pursuing are wider. They have to balance it with those sorts of economic issues, but that is not the end of the story.
Sure.
And don't forget that the law also has a trajectory.
It does,
And
and
so it's not
it
stable,
absolutely.
static, whatever.
I'm about
so,
to publish an article on that
oh,
very
there
point.
There you are. So I had a whole list of bones to throw into the discussion to get it going. I didn't have to use one of them. That is because of you, so thank you very much, because you were very interactive. That's exactly what I had anticipated. But of course, the most people that we have, the people that we really have to thank are the panelists. So thank you very much, because so... You were so responsive, and you know there was some tension. That's exactly what we need. We don't have a conflict of interest right now because we can all go to the same bar. Maybe there is because we want to have the wine first. So go for it, Divinity Halls, and then we have fun tonight. Thank you very much.
It was Zumba, yeah.